Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job, not just entertain, but to teach you. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. If you ask me what tech stock I like right now, right here, I tell you that my favorite tech stock is Procter Gamble, a house of innovation that spends more than $2 billion a year in research and development to make the best personal products imaginable. From Pampers that can handle a pounding to Tide Evo detergent with 6 levels of clean to the Gillette Labs heated razor for the best shaving imaginable. This company is loaded with the kind of tech I'm willing to pay for. And get this, its stock's on sales down more than 13% for the year. And management already told you they're going to miss the quarter, so it's what we call de-risk. In this wacky market, you want those who use the technology, not those who make it. You can see that on a day where the Dow dipped 41 points, S&P declined 0.16%, but the tech-laden NASDAQ dropped another 0.59%. In this market, you want the stock of Procter Gamble because it's cheaper than I can ever recall. With a new CEO coming in, a monster user, not maker, but user of tech, which is what's working now in this stock market. See, Procter Gamble used AI to fix the supply chain, uses digital twin technology to design its new factory, saving millions of dollars versus old construction. It uses AI to figure out how to cut down on supplies that it doesn't really need. So, no, I'm not being facetious. My favorite tech stocks right now are the business-to-business users of technology. I think these companies will increasingly be given a chance to buy amazing tech that will help them cut costs and bring new products to market much faster than ever, and that we never even knew we needed. Heated razors. It's just that we're so fixated on the producers of tech, we like the prurient interest of talking about the big guns in it, that we forget it's the users of tech that are getting the bargain, not the makers of tech, and their stocks remain very expensive. It's hard in this market to find a bargain like Procter that sells for just over 20 times earnings with 2.9% yield. Not bad when the president wants rates to fall to 1% and you can compound. It's certainly hard to find that kind of valuation among the traditional tech plays right now. The techs have lots of wood to chop before they settle into better, more viable levels. Procter, though, it's already so cheap. Right now, the actual techs, the companies we call the Mag 7, the semis, they've had gigantic runs and are pulling back because their future prospects are so darn murky, and they've had such a giant move, and it's proven to be indigestible. Just consider a couple that we own for the choppers. So we like these. Okay, we like these. I'm just giving you straight dope here because I don't want to trade. I want to start with Amazon, big position of ours. Here's a company that can send you anything overnight or increasingly during the day at a low price. Has a thriving ad business. Has the Amazon Web Services business. Represents less than 20% of the company's revenues, about 60% of its total profits. AWS is now the core business, and it spends billions upon billions on semiconductors, data centers, energy. I don't want any of that. I just want a package delivered to me, and I'm happy to use Walmart if it's got a ton of technology itself instead of Amazon if it's cheaper. Now, Amazon stock is up about 1.5% for the year. That's not that good. The amount of money they need to spend to keep up with their competitors in the race for AI supremacy is insane. But what are they going to do? Let OpenAI come into the retail and web services business, take away their clients? Let Walmart use their stores to beat Amazon its own game? Amazon's strategy is not spend to win, it's spend to defend. I like to win. Meta's interesting. It's up almost 11% for the year. Not much, but better than Amazon. Stock sells for 22 times next year's earnings. That's kind of cheap. Kind of ridiculously cheap if you like the management as much as I do. But it's also spending like mad, perhaps as much as $100 billion next year for capital expense. And I'm not even thinking about these huge pay packages the company's using. No salary cap in tech. Hey, guys, go fix that, will you? Get like a CBA thing. For that capital spend, Meta's getting power plants and data centers, both of which could be, frankly, out of date by the time they're done. Again, though, they don't have a choice. If Meta takes its foot off the pedal, then OpenAI might start coming in after them in the social media space. All these big tech companies live in fear of that. They believe that whoever wins AI could potentially win everything else, too. And if you let OpenAI in with this chimerical balance sheet that you've been binged, that's what'll happen. You'll be binged. And you know what happens if you've been binged? That's Microsoft has Bing and the other guy, Google, has Google. Well, it's going to be like Carrie. We're all going to laugh at you. I know the stock of Meta, like many of the tech cohort, hasn't done anything for months, while stocks in the transports and financials, man, they're just flying. The only thing that would get Meta stock moving is to come out right now and say, listen, we're not going to pay all this. We're not going to pay all this for power. We're not going to do all these data centers. And I have no idea how they can do that without losing their edge. How about Microsoft? When's this one going to bottom? The stock's only up about 13% for the year now, but it remains a fixture at the office, jamming teams down our throats and offering us co-pilot when we don't even need a regular pilot, let alone all the junk they punish us with. You know what? I've been buying things on their thing just so they won't come up, but they still come up. Those of us stuck with a PC that's based on Microsoft instead of the pristine Apple, which has been the case for me for decades, know that the real workhorse here is business to business. Microsoft's in an unassailable position, but it requires massive spending to keep Azure, the cloud infrastructure business, competitive versus Google and Amazon. These are three of the richest companies in the world, all going after the same piece of the pie. So why not jam the captive audience? We can't do anything about it. Truth. And it's not just Microsoft. Almost every single tech company I follow has a monstrous set of rivals spending tens of billions of dollars to dominate the particular industry. Now, in one case, that spending can be worth it. Google spent enough to keep the comers out of the search category. It's been allowed to write a check to Apple to make it the default search. That cost them $20 billion per year, and it's the money well spent now that the contract has been blessed by a federal judge who must have lost his mind. I now expect Google will also pay Apple to make Gemini their default AI chatbot. Ooh, that judge will like it even more. At that point, even OpenAI playing with their other people's money may not be able to compete. In other words, these big tech stocks can't advance unless they can rein in their spending, but I just don't know how they can. Not as long as OpenAI is out there with a CEO who wants to win in every vertical as a privately held company that has plenty of investors who are eager to throw money at him because I think they want to be cool. Can you imagine if someone came into the business, all the businesses that Procter Gamble competes with twice the R&D budget? Believe me, as much as you may like P&G products, that R&D-laden competitor would have a couple of things that you'd switch to destroy Procter's profit margins. Understand, I'm not trying to say that tech stocks can't be owned here. We own a bunch of them for the Travel Trust. We always have, along with NVIDIA and Broadcom. I really like them. I'm just a lot less enthusiastic than I used to be because there's competition all over the place, and they're spending like crazy, and the stocks have still had big moves. I've never made big money betting on a company that's involved in a scrum where every competitor has got a ton of money. Right now, Alphabet's the only one that seems to be winning. I don't know. I mean, we need more winners, but it's just Alphabet. The amazing thing is, when I look at artificial intelligence plays, the traditional ones, not the Sandisk and the Microns, which are going up like crazy, but that'll end too. All I can say is that there's no bubble brewing. If there was a bubble, it burst at the end of October, when pretty much all these stocks stopped making money, and most of them started going down during the end of the year of magical investing. Remember that? Bubble brewing. It popped already, numbskulls. Bottom line, the difference between the big tech and Procter Gamble, most of the tech companies are simply spending to keep up with the Joneses here. Procter spends to dominate, which is why I think it's worth buying right here, right now, alongside the Travel Trust, where a dividend gives you a floor, and there's no CapEx ceiling in sight. Let's go to Nick in Florida, please, Nick.
Hey, Jim.
Nick, what's shaking?
About Verizon stock. Everything's good. Thank you for asking.
No problem.
Verizon stock is often viewed as low volatility income play. With the current market conditions and interest rates dropping, do you think it's a good dividend yield against
Never
fixed
buy
income?
a common stock as a bond. You buy common stocks for growth, and if they happen to give you income, that's great. But common stocks are not bonds, and they'll end up disappointing you. Verizon is down 5%, and I think in the last 6 months, and I think that decline may just be getting started. Look, it's hard to identify winners in tech right now with all the spending going on. I mean, come on, guys. But a stock like Procter Gamble that spends to dominate, that can be bought right here, right now. Mad Money tonight. Oh, another one I like. The firm announced this new partnership with Revolve today. I'm getting a read on the deal and the move into UK. Get ready, UK. And then that's that buy now, pay later stuff. Then the long knives are out for Oracle, as I just mentioned, at their lackluster earnings report. And I am sorting through the negativity to tell you where I stand on the name. And the industrial gas company Linde has been heading higher since its investor day last week. And I'm sitting down with the CEO to find out why. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.